Hey, what's going on, everybody? It's Wednesday, September 4th. We had such a rainstorm. Florida, man, in the summertime, really something. I mean, we had the most torrential downpour here about an hour ago that the road in front of my house, it became a lake. The road disappeared. We had a few inches of water from my property all the way across the road. It's gone now, it drained out, but man, I thought I'd be able to catch my dinner in that thing for a minute because it was a lake. It was a lake. But anyway, you could probably hear like the crickets and the wildlife in the background. Nice little background noise. Anyway, today was kind of flat. I think Dow was up a little bit. NASDAQ and S&P was down. A couple of interesting things. Number one, and this is something that I talked about a couple of weeks ago, was the fact, and I find it humorous, I find it funny, because again, it's another one of these monetarist, cuckoo stories where black is white, up is down, right is left, where when their argument and their theories fall apart, they just kind of reinvent them to suit the outlook of what's, to justify their outlook. So we know for a long time, forever, that their tried and true recession indicator was the inverted yield curve. We've been hearing about that, or I've been talking about that for years, and that's always been out there, put out there by the monetarists. I've debunked it many times. The inverted yield curve, that really is applicable if you're going to use that as a recession indicator or as some sort of an indication that there's going to be a contraction or a slowdown. That really comes into play under a kind of a gold standard regime or some kind of a fixed exchange rate regime, okay? But when you have a fiat currency regime where the nation's liabilities are denominated in its own currency, everything is in its own currency, it's not applicable. I mean, banks make loans based on the credit worthiness of the borrower. Loans themselves create deposits. They're going to price in an interest rate on that loan that'll give them a profit, and it doesn't matter what the shape of the yield curve is. I've been saying this for a long time. So we just went through this period where we had the longest inversion of the yield curve ever on record. Historic length of time that the yield curve has been inverted, no recession. So what's happening now, and this is why I'm laughing, is that now when the yield curve is uninverting, and I think the term they use is disinverting, okay, going back to a positive slope, they're saying, aha, that's the real recession indicator. So like when that used to be viewed as a quote unquote normal situation that would correspond to, a healthy economy, a positively sloped yield curve, now, all of a sudden, because the inverted yield curve predicted nothing, as I said over the years, it's not just like I came out and said that recently. I've been saying that for years. Anybody who has ever followed me for any length of time knows that I have consistently debunked this claim that the inverted yield curve was some kind of a recession indicator. And I've explained why, just like I explained why a couple of seconds ago. But now, since the monetarist, theories with respect to that inverted yield curve completely fell apart, they're now flipping around saying, oh, the real thing is that the uninversion of the yield curve is the true recession indicator. Now, here's what I find to be both interesting and comical at the same time. We may very well go into a recession in 2025 for reasons that I have been giving. Number one, the Fed rate cuts are going to start to siphon off those interest income transfers that have been fundamental extremely important in keeping the economy in a growth mode. And by the way, the growth hasn't even been that much. We're like at a 2% GDP growth rate, despite the fact that there's been like, and I've explained this to you guys, there's been like $1 trillion of interest income transfers this year alone. And that has only managed to keep the economy growing at 2%. But when the Fed starts to cut rates and those interest income transfers are reduced, and then as I've been telling you guys, next year when we have the expiration of the Trump tax cuts, possibly a smaller increase in the COLAs for Social Security, Medicare, Medicaid, Veterans Pay, Disability, all that stuff, you're going to see there's going to be a lot more fiscal drag, and we may very well drop into recession because we're only growing at 2% right now. And when that happens, I'll tell you this right now, the monetarists are going to say, you see, we were right. The disinversion of the yield curve is a fantastic and very prescient indicator, forecaster of a recession. And then they will latch on to that. They will hang on to that. And from now and forevermore, possibly, they're going to be saying when that yield curve disinverts, that is the best recession indicator out there. Not when it's inverted, okay? That no longer means anything to them. Even though it meant something to them for decades, it no longer means anything to them because it didn't work. You would think they would go back and try to understand why it didn't work. But no, they're just going to come up with another excuse, another explanation, another rationalization. And this time it's when it disinverts. So, I mean, come on, folks. This is a joke. And, you know, this is coming from the highest levels of Wall Street and finance and economics and academia. You got people out there who, you know, I jokingly refer to as, you know, very serious people, talking about this stuff, flip-flopping on their explanations, you know, throwing away one explanation because it doesn't work, coming up with another one without even examining the reason why the first explanation didn't work. Just let's ignore that. Let's rationalize it in a different way now. Once again, not understanding. I mean, if the economy goes in recession next year, which I think there's a high probability based on the things I've been telling you. We have to get through the election. We have to see who gets elected. We have to see what the policies are. I mean, I could be wrong because the Trump tax cuts might be extended. We may get some new fiscal. I don't know. So we'll see. You know, once we get through the election and once policies are not just proposed but enacted, I'll be able to make a better assessment. But right now, given what I see, without any changes, there's a very high probability of a recession in 2025 if things stay the way they are, which is, and by the way, I'm not even talking about, or I haven't even mentioned the fact that Congress has to come up with at least a continuing resolution at the end of this month, or there's a government shutdown, okay? They got to raise the debt ceiling by January 1st, 2025. I haven't even mentioned those things, but those are two things that, you know, that are out there that are potential time bombs too with respect to the fiscal outlook. All right. Now, regarding the fiscal outlook, back in early August, I said that from August 15th to September 2nd, September 3rd, we are going to see the peak in the fiscal flows for this cycle, okay? And boy, did it peak. I just looked at the data from the daily Treasury statement today, which covered through yesterday. Total withdrawals, Treasury withdrawals, you know, leading flows up 161 billion over last year. I mean, that was an enormous spike. You know, when we got those September 1st payments, which came through, actually they came through on Friday and they came through yesterday. That's an enormous spike, one of the biggest year over year differentials that I've seen in a long time. So leading flows, I mean, it almost makes me kind of rethink my slowdown scenario, because those leading flows are Like, that's a tsunami. That is really, really strong. Now, remember, this is the peak. We got September 16th as a quarterly corporate tax drain. We got to get at least the continuing resolution. You know, Congress is not going to pass a full budget. They haven't done that. I can't even remember the last time. We go from continuing resolution to continuing resolution. So that has to happen by the end of the month. And Trump has thrown in kind of a wild card, if you will, or a wrench in the works, because he is demanding that the Republicans include the so-called SAVE Act in any new funding bill. The SAVE Act is an act which requires proof of U.S. citizenship to vote. Now, that just seems logical, right? I mean, like, but it's not written into law. And he is now pushing hard on the Republicans in Congress to include the SAVE Act into any new funding bill, any new spending bill. And supposedly the Democrats are going to balk at that. I guess they need the votes, all right, from non-citizens. But I mean, doesn't it make sense that you have to be a citizen to vote? I mean, come on. And, you know, is it too much to have to show proof of that? I don't know. Anyway, that's one development now which raises questions about whether or not a funding bill is going to get passed by September 30th. All right. By the way, folks, please like and subscribe. I always forget to come out and say that in the beginning. You know, you've been doing it. You guys have been great. I really appreciate it. It helps the channel a lot. So if you've done that, thank you very much. If you haven't, if you could just take a second to click the like and subscribe button, I would really appreciate it. Thank you very much. So right now, really nothing has changed. We have the tax drain coming up on September 15th, which is going to be a negative for the market. We have very, very strong leading flows. So I suspect that the tax drain, whatever negative comes out of the tax drain, it's going to be very short-lived, okay? Then September 18th, we're going to get our first interest rate cut by the Fed. We don't know if it's 25 or 50. Actually, the probability for a 50 basis point rate cut jumped up today by 8 percentage points based on where Fed fund futures are trading. Friday is an important day. Here's another thing that I found very interesting, and a friend of mine brought this up to me. He had an observation which I thought was very interesting. He said, now, because monetarists are thinking, oh, the disinversion of the yield curve, and what is that being caused by? It's being caused by expectation of rate cuts. If monetarists believe now that the disinversion of the yield curve is a bearish thing, it's an indication of an oncoming recession. Remember, that's their, rejiggering of their view. He said that if the economic data starts to come in weak, and we have the job number coming out on Friday, okay? The August jobs number is coming out on Friday. If that number comes in weak, the monetarists are going to be triggered to sell the market. Remember, in the past, weak economic numbers, they cheered. They said, that's fantastic because we're going to get a rate cut. That's another thing they're flip-flopping around on, right? So now it's like, oh, a rate cut? You mean the economy's slowing down? Oh, we better sell. So bad news is bad news now. It used to be bad news is good news, and good news was bad news. Now bad news is bad news, economically speaking. So this Friday's job report is going to be very interesting, and it may be very impactful. So we got the job report coming up. We have the quarterly corporate tax drain, And then we have the rate cut. And once again, I want to repeat that I don't like to come on here every day and say, the market did this because of this, or the market did that because of that. It's almost impossible day to day to, put some reason on why things are jumping around. There's a lot of noise in prices. I said the other day, it could be due to so many different things. It could be due to a headline. It could be due to somebody saying something, a Fed official. It could be due to some big position adjustment by some, big player in the market. What I want you guys to focus on is the macro picture. And I stay right now, despite the fact that I say leading flows are very strong, we are about to come into a change or a shift in the monetary fiscal dynamic for the first time in over 2 years. And that is represented by the Fed now embarking with these rate cuts. And then all the things I mentioned for 2025, not to mention the fact, got to get a continuing resolution or a budget passed by September 30th, the debt ceiling by January 1st, the lower increases in the COLAs for Social Security, the expiration of the Trump tax cuts, all these things. I'm painting the landscape for you going out, all the way through next year, with the understanding that let's get through the election and let's see what policies are enacted. But right now, it does look like to me that we are going to enter into a period where there's going to be more fiscal drag, and the economy is only growing at 2%. So it won't take a lot of fiscal drag to slow it down to maybe zero growth. And again, monetarists, if they view that, they attach that to the disinversion of the yield curve. I know all this stuff sounds crazy, but try to follow me on this. It could set the market up for a negative period. I believe it. A little volatility between now and September 16th. But yeah, that's what I think. Anyway, that's it for today, folks. Thanks for watching. Don't forget to like and subscribe. And don't forget, go to my website, because look, I put out emails all day long, some stock recommendations, some always MMT discussion, pointing out things that, the monetarist interests are looking at or rationalizing, making you understand that stuff or helping you to understand that stuff, the education that you get from it. pitbulleconomics.com. See you tomorrow. Bye.